This is our final lesson for Chapter 12 and for this course. Building on our coverage of capital budgeting in Chapter 12, Part A, we'll look at evaluating our cash flow analysis for risk. Once we've created our pro forma cash flow statement and calculated evaluation metrics, we still need to do some risk analysis. After all, the pro forma is built on estimates. Our topics include sensitivity analysis, scenario analysis, and real option analysis. First, let's take a look at the three kinds of risks to be considered. Standalone risk, the risk of holding an asset in isolation. Corporate risk, the risk of a project as part of the corporation. Market risk, the risk to a well-diversified investor. Standalone risk is the risk as if the project is a standalone business. It's usually measured by the standard deviation of expected returns, but it ignores diversification if the project is part of a firm's portfolio of investments. Corporate risk measures how a project fits within the firm's portfolio. Does it create diversification benefits? It relates to the correlation of the project's returns with those of the firm. Market risk reflects the risk to a well-diversified investor. Theoretically, it's measured by a project's beta, which is very difficult to determine. Market risk is the most relevant, but the most difficult to measure. Standalone risk is the easiest to measure, so is frequently the focus of decision-making. And though it's not theoretically correct, it's not necessarily wrong either. In truth, all three types of risk are quite frequently highly correlated, so focusing on standalone risk does not necessarily lead to poor decisions. The first method of risk analysis we'll look at is sensitivity analysis. It measures the effect of a change in one variable on the project's NPV. This table shows a sensitivity analysis on our proposed project. We're using the inflation-adjusted pro forma as the base case. We selected three variables to focus on: unit sales, salvage value, and cost of capital. For each variable, we hold all other variables constant and let the variable of interest change by plus or minus 10, 20, and 30%, and recalculate NPV at each level. This example is posted as an Excel worksheet with this lesson. Graphing the data from the table, we can observe the units line, the red line, is the steepest and is upward sloping. That means that the relationship between units and NPV is direct. Units goes up, NPV goes up. The salvage value line is the flattest and upward sloping. Again, a direct relationship. The cost of capital line, the blue line, is downward sloping, indicating an indirect or inverse relationship with NPV. When the cost of capital, the discount rate, goes up, NPV goes down. The steepest line indicates which variable has the most impact on NPV. This indicates which variable should receive the closest attention in forecasting. Creating the table of changes is time-consuming. We can get the same results with less computation by calculating a sensitivity ratio for each variable. Note, this is not in your textbook. To find a sensitivity ratio, we need the percent change in NPV. We need the base NPV and the new NPV. The percent change in the variable of interest, base value of the variable and the new value. We already have the base values, and we can choose the percentage change for the variable, so all we need to calculate is one new NPV, and we can find the sensitivity ratio. If the sensitivity ratio is positive, the relationship is direct. If negative, the relationship is inverse. The largest absolute sensitivity ratio is the variable to focus on. For our project, let's let each of our variables of interest change by a negative 30%. These numbers come directly from the larger table. The percent change is equal to quantity new minus old divided by old. For example, for units, minus 53,776 minus 10,406 divided by 10,406 is equal to a minus 617, minus 617%. Repeat this for salvage value and cost of capital. We have the percent change in the variable since we selected it, minus 30%. For units, then, the sensitivity ratio is a minus 617% divided by a minus 30%, equal 20.56. Again, repeat that for salvage and cost of capital. Placing these sensitivity ratio values on the graph, we can see that they correspond to the results found earlier. Units should be the variable of focus. The main advantage of sensitivity analysis is that it identifies the variables where focus should be placed in terms of ensuring the best forecast possible. Since units has the most impact on the resulting NPV, it should receive the most attention. On the downside, sensitivity analysis measures standalone risk, so it doesn't consider any within-firm diversification benefits, nor does it address the possibility of forecast errors. We've all heard of best case, worst case. That's scenario analysis. Our base case is our original pro forma. In this example, we feel fairly confident of all the variables except units. This table represents our analysis of the potential outcomes for units, their associated probabilities, and the resulting NPVs. All other factors shall remain constant, and the NPV under each scenario can be determined. Using that data, we can find the expected NPV as the weighted average of the three outcomes. We can also compute the standard deviation of the NPVs and the coefficient of variation. If this firm's average risk project has a CV between 125 and 175, then this project with a CV of 3.6 is riskier than the firm's typical project. Assuming a plus or minus 4% cost of capital risk adjustment, reevaluating this project at 14% cost of capital due to the high standalone risk, the NPV of the project is a negative 10.83. If it were a low-risk project, a 6% cost of capital would result in an NPV of 35.09. Assuming the plus 4% adjustment is considered appropriate, the project is a no-go again. Beyond pure numerical analysis, some purely subjective factors might deserve consideration. Potential for lawsuits could increase a project's risk. If the assets used by the project can be reused, redeployed, or easily sold, then that could reduce the project's risk. Our final topic is real options. Capital budgeting, as we've covered it so far, is basically static. The assumption is that if a project is accepted, it will be pursued exactly as defined, no changes made once it starts. The real world doesn't work that way. The potential to improve or even abandon a project can impact the NPV. Real option analysis allows us to investigate the impact of midstream changes. While the actual application of true real option analysis is beyond this course, we can take an overall look at what it involves. Real options involve anything that can be done before or during the project's life to reduce risk or improve profit. Abandonment, contraction, temporary suspension are all options to reduce risk. Investment timing options could involve starting with a pilot project before committing major funding, or delaying a project start to obtain better market data. Expansion options could involve adding new items, new products, new markets. Flexibility. Consider a BMW plant in South Carolina designed so that the production line can be easily shifted between sedans and SUVs. Without going in depth into the numerical analysis of real options, let's look at a simple abandonment example. Our new project Y has an initial cost of $200,000. Firm's cost of capital, 10%. Expected cash flows for 3 years, $80,000 a year. Straightforward NPV, minus $1,051.84. It's a no-go. Suppose, however, that we believe there's a 60% probability that customer acceptance will be very good, generating cash flows of $150,000 each year. But there's a 40% chance of poor acceptance, leading to a negative $25,000 each year. Here's the revised dual-path timeline with the cash flows and probabilities shown. Again, straightforward NPV analysis yields an NPV of 173,027.80 for the top leg, a negative 262,171.30 for the lower leg. Applying the 60-40 probabilities yields an expected NPV of 105,184, the same as under the single path line. Suppose further that the firm cannot delay the project, but they can abandon it after the first year if customer acceptance is poor. This further revised dual path timeline reflects abandoning the project after year 1 on the lower leg. Upper leg NPV remains at 173,027.80. But the lower leg changes to a minus 222,727.27. The addition of the option to abandon has turned this project from an NPV of a negative 1,051.84 to a positive NPV of 14,725.77. Since the abandonment option reduces risk, it could also reduce the cost of capital, further improving the NPV. This ends our coverage of capital budgeting and ends this course.